Want to learn how to start your investment journey? Today, I'll be sharing everything you need to know to start investing. Hello everyone, welcome to the NASTI Dynasty, where we all learn about life-changing habits, skill sets, and mindsets to help us all become more nasty. Previously, we talked about what exactly is investing, as well as why you should start investing early on in your life. But for today's video, I'll be covering everything you need to know to start investing. This video will mainly be covering about stocks. So let us first understand what is stock. A stock, also known as an equity, is a security that represents the ownership of a fraction of a corporation. So often at times we hear the word stocks as well as shares being used interchangeably. So they are actually quite similar in a sense, but stocks is mostly used to discuss about one or more companies, whereas shares is used to discuss about just one company. So you can be like, hey, yesterday I bought some stocks versus hey, yesterday I bought some Apple shares. So now that you know the basics, let's dive right into the two most important factors for choosing a company to invest in. The first will be proof of concept. To put it simply, a company is basically worth the amount of value that it brings to the world. This can be seen from some examples like Facebook, who revolutionized the entire social media industry, even buying over WhatsApp as well as Instagram, and the stock price rise like some freaking dog. Other examples include Apple, that created the entire Apple ecosystem, as well as Amazon, that revolutionized the entire shopping industry so that you can even shop online. So when we look at proof of concept, we also want to look at companies that can disrupt market. Basically, disruption is when a company brings about an idea that is like kind of weird, but it actually works in a sense. Like for example, let's say 100 years ago, if somebody told you that you're able to talk to someone over a freaking phone, would you even believe it? Like people will probably think that it's like magic or some shit, and you'll probably be mistaken for a witch. But anyways, disruption is actually a damn important part of innovation. And let's just look at one company that has done this. Netflix. Netflix actually disrupted the entire DVD industry by providing an easy and accessible subscription-based platform for people to watch movies online. Their brand even spread so much that you probably heard the term Netflix and chill. And also, do you notice that because of Netflix business model, they are able to expand so easily because everything is basically online? And this brings me to my next point, which is having the ability to scale. So having the ability to scale actually can be looked from two points of view. The first is that a company can actually spread its products and services to a wider customer base damn quickly with super low costs. So one very good example of this will be like Facebook. Like they probably need to spend money mostly on marketing as well as the creation of some servers in the different countries. But when you compare Facebook to a random retail company, the retail company need to spend so much more money to even come up with the basic inventory to even open just one more branch. So the second component of having the ability to scale is that the company can actually expand so much more into the sector that it is diving into. The best example for this will be Tesla. Like to some of you, Tesla might just be a company that just sells cars. But that's not true. Tesla is actually a renewable energy company that is just using manufacturing of electric cars as its first step into stepping into the renewable energy market. Like if just selling electric cars is enough to give it so much exposure, you can already guess where Tesla will be like 10 years from now. But basically, when a company has the ability to scale, regardless of whether it's the first or the second component or even both, it means that the company still has a shit ton of room to grow. So by actually looking at companies with the ability to scale, we are able to find investment opportunities that help us to make the most out of our time and let compounding work for us. But when we are older, our priorities will probably change quite a bit. Like our focus will probably be on receiving passive income rather than growing whatever money we have left. And that is when we will look into dividend stocks rather than growth stocks. So what exactly are dividend stocks? Well, here is the easiest explanation. Hey, tolong lah investor, if you sell with my money, my company confirm toh bro. What the? Your company not even growing already. I can probably find better opportunities out there. Okay lah boss, don't say I'm not brother lah. If you don't withdraw your money and sell from my company, in exchange right, I will give you 2.5% of your money back every single year. Walao, like that say then can lah, sorry bird. But basically for dividend stocks, the profits that they gain are actually used to reward the investors in a sense for staying with them throughout the journey. Whereas for growth companies, the profits that they gain will actually be diverted right back into R&D to ensure that the company keeps on growing. But I guess right now, because of the fact that we are still young and we have so many years of compounding left for us, growth stocks is definitely the more practical way of going about investment. So now that we know about the two most important factors of choosing a company, let me provide you with two types of analysis that can help you to see whether the company is really suited for you or not, and whether now is the right time to buy the company. So now, let's say that you walk into this coffee shop and the chicken rice is so damn good. Will you pay $25 for that plate of chicken rice? But let's say right now we walk into a 5-star fine dining restaurant and they offer $25 plates of chicken rice. Even if it's not as good as the chicken rice from the coffee shop, we might still buy it because it's a fine dining restaurant, right? So what is with this stupid ass analogy? Basically, the coffee shop chicken rice is your Apple/Amazon like 10 to 15 years ago, whereas the restaurant chicken rice is what they are now. So by actually doing these two types of analysis, you can determine whether your super delicious coffee shop chicken rice will eventually move to a 5-star fine dining restaurant in the future, and how much you actually want to pay for that plate of chicken rice right now that may potentially be worth $25 in the future. So let's first talk about fundamental analysis, which is basically to reinforce the first two factors that we went through just now in choosing your perfect company. So if I were to use the stupid chicken rice example from before, I would say that right now, by using fundamental analysis, you're actually reinforcing your mindset of whether this chicken rice store is able to upgrade into the 5-star restaurant, or whether or not it's even nice in the first place. So to research on this, the most common website to go is Yahoo Finance, and you will see this search bar where you can either enter the ticket symbol or the company name. So a ticket symbol is actually the short form for a company's long ass name that is used in the stock market. Yeah, so after you check the company, you will see the market cap and price of each share. Market cap is basically how much the company is currently valued at, and price of each share is just how much money you need to pay, not counting commission fees for just one share. So on this page, you will mostly want to look out for news as well as the financial data of the company, which include the income statement, balance sheet, and cash flow. So I actually got a D for econs. Okay, but I got a D for econs, so I will just attach a video link in the description below so that you can analyze the financials to your own risk appetite. So a super important component of fundamental analysis is to actually analyze and generate your own personal valuation of the company. So basically, you want to ask a lot of questions and you want to find out how much the company is worth in your eyes 10 years from now. So in order to do this, you will need to look into the valuation of the industry that the company is trying to disrupt and how much market share of the industry can it actually capture. You can find out information on Google and YouTube and listen to the opinion of others and craft out your own personal opinion. It is extremely important for you to have confidence in the company, not because other people say it's good, but because you yourself think that the company is good. After you have researched and found out your own perceived value of the company, we can then move on to the next step, which is technical analysis. So for technical analysis, what you're trying to do is see whether you can bargain to get the chicken rice at a cheaper price or not. Personally, I'm not really a fan of technical analysis because I strongly believe that timing the market will never beat time in the market. So for stock viewing and technical analysis, I will usually go to tradingview.com, where you can once again input the ticket symbol or company name. So as you can see from this graph, it is by default a line graph. So what you want to do is that you want to change it to a candlestick graph. So compared to a line graph, you can see a lot more in this graph, and I will be attaching a link in the description if you want to find out more about how to do your technical analysis. Because I particularly feel that for investing wise, this is not exactly the most important skill set to have. Whereas if you are into trading, then yeah, this is damn important. Oh, and yes, there is a difference between investing and trading. Trading is actually just buying low and selling high, and just repeating that process over and over again until you actually earn money. For investing wise, you just want to buy and hold and only take out the money when we seriously need it or if you're about to retire. So now that I've covered the two main factors as well as the two types of analysis to help us to choose our company, let me just go through the two most important laws of investing. So as you guys might already know, the market is super unpredictable and it just keeps going up and down every single day. And the only way that we can prevent ourselves from getting screwed over by this market is if we prepare ourselves practically and emotionally. For the practical side, the most important law is diversification. In the book Unshakable, Tony Robbins mentions the 4 main types of diversification. But basically, diversification means to not put all your eggs into just one basket. So let us first talk about the first form of diversification, which is basically diversification across different asset classes. Basically, we have to ensure that in the long run, our investments are split into stocks, bonds, and other investments like, for example, real estate. This is to ensure that when the market profits, we profit. And when the market crashes, we don't lose as much money. A famous investor, Warren Buffett, first rule of investing is don't lose money. So this is actually pretty much quick math. Like for example, you start off with $10,000 and you lose 50% overnight. You're left off with $5,000. And if you want to grow that $5,000 back to $10,000, you actually need to grow it 100%, not 50%. For now, because of the fact that we're all still students, we don't actually have the income or the net worth to even diversify properly. But once we get into the working world and we start to earn our income, we have to always remember to diversify across different asset classes according to our own personal risk appetite. Next up is diversification within asset classes. Basically, don't dump all your money into your favorite company like for example Tesla, or go and dump all your money into a $10 million property. So investment is not about trying to win the $4.5 million Toto or anything like that. You want to slowly grow your money and ensure that your money is safe. So a very good way to diversify into stocks is to actually buy index fund. If you have a higher risk appetite and you don't wish to diversify with index funds, a very good way to do this is to just choose 3 growth stocks that you can invest your money into. This is because it is much easier for us to keep up with the news of 3 companies rather than like 10 companies. And also, if you force yourself to go and choose 3 companies, you will definitely make sure that these 3 companies, right, are the best companies out there that can provide you with the best growth potential. For real estate, if you're a poor kid like me, you can always look into real estate investment trusts, also known as REITs, which are basically the mutual fund of property real estate investment, I guess. So REITs actually provide you with an opportunity to diversify across different properties across different countries. But basically, in addition to diversifying across different types of investment, we have to also dive deeper to diversify within each investment class. Next is to diversify across markets, countries, and currencies all around the world. We live in a global economy, so don't make the mistake of investing in just your own country or one country in general. I personally feel that the best way to do this is to invest in China stocks as well as US stocks. And no, it's definitely not true that China stocks or US stocks is more risky than Singapore stocks. Remember, as long as you properly do your research into companies like Tesla or Baidu, you will definitely experience much lesser risk if you were to just invest into a random Singapore company that you didn't do your research on. So the last form of diversification is actually to diversify across time. You never know when is the right time to buy anything. But if you keep adding to your investments systematically over months and years, aka dollar cost averaging, you will reduce your risk as well as increase your returns over time. You enter the market at lows and highs to ensure that you average throughout and that you don't accidentally enter the market right before a crash. Like I said before, you never know what might happen, so it's much better to be safe than to be sorry. So now that you understand the importance of diversification, let us talk about the second law of investing: emotional mastery. I will mainly be talking about 2 emotions, fear and greed. It's damn normal for us to experience all these kind of emotions because humans in general, we are just made to survive. And it might cause us to make some irrational decisions at times. So let's say that today, you buy some Apple shares, and the next day, Apple suddenly decreased 15%. Because of our brain's instantaneous fight or flight response, the first thing that comes into our head is to faster sell and buy back when it drops even more. But as you all know, the market is damn crazy, and you never know whether the moment that you sell the freaking stock, it just rises 15% right after that. So you can actually pause your screen or take a screenshot right now of these 7 facts of how the market works to constantly reassure yourself about your investment mindset. It is extremely normal for you to fear losing money. In fact, if you don't fear losing money, I don't know what the hell you're doing. We have to constantly remind ourselves to think and make the smart decision, which definitely doesn't feel smart at that point of time, trust me. But you have to remember these 7 freedom facts so that you are able to reinforce your investing mindset and not make any irrational decisions. With a correct mindset, whenever the market falls or when you see red days, we will look at it more of a Black Friday discount rather than thinking that the entire company is going to zao. In addition, always remember to do your own due diligence as well as research on the company to ensure that you have confidence in your own decisions as well as in the company so that you don't let fear take over you and panic sell the stock. So you notice that I talk about panic selling a lot, but when should you actually sell the shares of a certain company? Other than the sudden need for money or when you're about to retire, you should only sell your stocks when these 2 things happen. So a stupid example would be that you should only sell your Apple stocks if one day Apple decides to stop selling iPhones and Macs and they decide to go and just sell like fruits or some shit. Or if you discover a company that is better than Apple in terms of its ability to scale as well as its proof of concept. Now let's talk about the second emotion, which is greed. Trust me when I say this, but greed is actually way more scary than fear. For fear, at least you try not to lose money, but you don't gain money also. Whereas for greed-wise, it's the complete opposite. You try to win money, but you might probably lose money as well. I mean, we're humans lah, so of course we'll try to think of some shortcuts or some easy ways to earn money such that investment becomes something like gambling. If you win money, then good for you, but if you lose money, well, trust me, you will be kicking yourself over and over again and you won't even be able to sleep. Humans, you know, we are all stubborn creatures and we won't actually think that something is bad until something bad happens to us. So one very good way to ensure that you don't go through bad experiences to learn is to just don't be overconfident. So just make sure to constantly educate yourself and learn more about investment and everything in general so that you don't become overconfident and think that you are better than the rest. One very good way of doing this is to read books or even watch investment videos to ensure that we are keeping up with the market trends, as well as checking whether our investment strategy is really the best or not. But basically, for emotional mastery, trust me when I say that fear and greed are actually the most scary things about investing. If you take the effort to recognize and fight these emotions, let me tell you, your investment journey is going to be damn smooth. So let's just recap. I've actually went through the 2 main factors as well as the 2 types of analysis to help you to choose your company, as well as the 2 main laws of investing. So to wrap things up, I actually just want to say a huge thank you for watching part 1 as well as part 2 of this series and sticking to the end. Like even when I'm talking like this, right, talking about how good investing is and everything, I understand that starting investing is not easy and taking the first step is extremely difficult. But trust me when I say this, your future self, be it 20 years, 30 years, 40 years from now, will thank you for starting today. Always remember to invest safe and let me know in the comments below if you have any questions and I will try my best to answer them. Whenever you feel in doubt of your investment choices, just rewatch this video and ensure yourself that you're not making irrational decisions because of fear and greed. Once again, thank you so much for watching to the end of this video and I will see you next Monday. Always remember, stay nasty.